Welcome Morningstar's Director of Manager Research, Laura Lutton, and Morningstar's Chief Marketing Officer, Rob Pinkerton.
Listen, baby.
Our Investment Conference has brought to you some of the brightest minds and best ideas in investing. And this year we have 8 excellent keynote speakers and 5 focused breakout session tracks for you to choose from, as well as a host of other experiences.
So, Laura, our teams that put this event together love this tweet from Keith Aker, where he called this event his Lollapalooza, which is a multi-decades-long global music festival that also showcases some of the top figures in that industry, but also provides a platform for new and emerging voices as well as ideas and innovations, which is really the guiding principle that we use to select speakers at this event.
That's right, Rob. So let's get started. Let's give Keith what he came for. It's my great pleasure to welcome our first keynote speaker, Morningstar's Chief Executive Officer, Kunal Kapoor.
Good afternoon, everyone, and welcome to lovely Chicago. We're always thrilled to host you here at our annual conference. It's always a point of pride for everyone at Morningstar to welcome all of you here today. So thank you for making the trip out, and thank you, Laura and Rob, for the warm introduction. It's great, particularly, to have everyone back today because it's a week prior to Morningstar celebrating its 35th anniversary. So it's special all around. Now, I've been part of our great firm for more than 2 decades. And while I like to use the stage to talk about everything that we're working on, and I assure you I'm going to, I also want to use the time today for some reflection. Because I think the story of Morningstar is the story of the modern financial advisor. We helped many of you get going when you were starting up your practices 20, 30 years ago even. And today, as you're evolving, so too is Morningstar. An advisor's practice today looks far different than it did 2 decades ago. And I can tell you the Morningstar that I walk into every day also looks far different than it did the day I joined. But I want to focus today in particular on 2 areas. The first is what hasn't changed, which is Morningstar's values and the principles that drive how we operate. Second, I want to talk to you about those values in the context of what has changed, how we deliver value for you and the investors that we jointly serve. Now, I know that you likely hear this message from other firms as well. I'm sure many of you go to several conferences and you get some version of this message. But when you come to our conference, you hear an original and raw perspective that actually lives up to our heritage. So while I believe strongly that the value of financial advice and the role of a financial advisor is increasing in society more than ever, I also believe that the level of difficulty to be successful in your role is also increasing materially. There's new technologies, regulatory changes, business shifts, ESG, and perhaps an increasing number of millennial clients. So what does that mean? It means that advice is going to be more personalized. And so with that in mind, I want to share with you today how Morningstar is navigating change to ensure that we're always guided by our North Star, which is our mission of empowering investor success. I'm going to say that again. Our mission is to empower investor success. And so this means, to start out, that when you do business with us, it is important that you know that you are doing business with our values, and that those values are integrated into every service, platform, data point, and person that you meet and get from Morningstar, alongside every interaction that you have with us. This hasn't changed in all the time I've been here, and it's not going to change tomorrow. And even as our firm evolves, this part of us will hopefully continue to stay true. It's our intent to keep it that way. You will never lose a client's trust for working with us. So our commitment to investor success manifests as specific and tangible policies that we think are universal, and you're welcome, I think, to adopt these yourselves, because we think they're really fantastic and that they're relevant to your practices as well. And I'm going to talk specifically about 3 principles that underpin everything that we do. These are very, very important to us at Morningstar, and I think they're important to all of you when you think about serving investors. The first is that our opinions are independent. Pretty simple, straightforward point. The second, our actions are transparent. And the third is that we invest for the long term. Independence, transparency, and a long-term approach. Simple on paper, harder to do in reality. So how do we do it? Well, Morningstar was founded on a principle of independent research. And while sometimes I take it as a given, our research has stayed fiercely, vigorously independent. There's just no doubt that our opinions represent the unvarnished thinking of our analysts. And many of you who've had the opportunity to read our research, and I hope all of you do, will find that we just don't hold back. There's no prearranged business relationship or foregone conclusions that dictate our opinions. At this conference, for instance, we don't select speakers or present awards based on business arrangements, which is quite common elsewhere. Everyone is on the agenda because we think you and the clients you serve will benefit from hearing from them, and that knowledge will help you when you go back to your practices. For 35 years now, our research operation has been managed entirely separately from our sales and product operation, and we're keeping it that way. Our analysts aren't afraid to issue negative ratings, often unheard of elsewhere, if things don't meet our standards, and we stand by those ratings. We believe now that hundreds of due diligence groups globally rely on our manager research as an increasingly important factor in their processes. And when a client calls to complain to me that they don't like something that an analyst has written, and let me tell you, they do call, I do immediately refer them back to the analysts, because it is ultimately up to the analysts to make those calls. Now, I learned the value of this independence as a young analyst myself at Morningstar. And I was thinking about how best to illustrate this, and I dug up an example of a fund I had to cover early in my career. And I was the lucky guy who had got to call this portfolio manager after the previous analyst had led off with the tagline, "This fund's eye for value needs a visit to the optometrist." As you can imagine, it was not the most pleasant of calls for me, but that's the investor-first environment that I personally learned in, and that many of us at Morningstar continue to learn in, and I hold it in esteem as the leader of our organization today. It carries over even to our investment management and our retirement offerings. We never pay or charge fees so that our offerings are available on one platform or another, because those fees aren't necessarily about the success of investors. In fact, recently, we were asked whether we would list our newly launched mutual funds, which are only available through financial advisors, on a broker-dealer's platform. And we said, yes, we'd be interested, but then we were told we'd have to pay a fee that wouldn't be disclosed. We said no immediately. And of course, we are on that platform today, even though we have not paid that fee. So sometimes it makes sense to hold your ground in that regard. As the industry consolidates and these lines begin to blur more unpredictably, it's really important to have an independent partner to guard your own credibility. And that leads to my next point, which is that our actions are entirely transparent. If fees and conflicts are not disclosed clearly, we just won't conduct business in that ecosystem. And I want to ask you this question of whether you really know every fee and cost that's wrapped up in the plans you're giving your clients today? My guess is that those of you who work with us closely know exactly what the answer is there. But that's not always the case. Take our fiduciary services business. Our fees don't change based on the funds that we recommend in a lineup. And you might be surprised to learn that this is not a standard industry practice, that in fact you can charge, and people do charge and get away with charging fees for recommending certain funds. But we choose to follow our values over standard industry practices. And all this is important because the practice of investing itself, as you know, is fraught with conflicts, hidden fees, and incentives that put industry interests often ahead of the interests of the client that we're jointly trying to serve. So I challenge you to do more diligence here, because even as fees for asset management are coming down, the fee to end investors is staying stubbornly high due to poorly disclosed fees that are wrapped into fanciful categories such as platform fees. On the research side, our ratings have nothing to hide, as I've shared. We assign ratings based on transparent criteria and report on the performance of these ratings on an ongoing basis, so everyone can understand how we got to our conclusions. Now, I know that this transparency invites scrutiny and produces stronger outcomes. And if you think back to the Morningstar Mutual Funds Trust, which I referenced earlier, we created it on the premise that we could work with advisors to make funds with lower costs that allow savings to be passed directly to investors. Now, creating these funds was a big deal for us. We talked about it for almost a decade. And we have strict governance rules to ensure that we accomplish the goals that we set out to achieve. So first, the chair of our fund board is independent. And more importantly, 75% of the board itself is independent, well above the minimum that's required. So independent oversight creates heightened checks and balances, as you know, and we take it seriously. Equally importantly, we have what we feel to be the most transparent prospectus disclosures possible for our funds, including line item disclosure of custodial fees, which is uncommon. Our analysts have complained about this for years and years, and now that we have an opportunity to do this right, we're trying to show the industry how to go about doing it. We're not explicitly required to do this, but in an age where things are changing, we want to be very, very clear. Recently, we also mailed a notice to all our clients letting them know how their personal information is used if they're in the funds. Now, we're not explicitly required to do this, but in an age where data privacy is on everyone's minds, we want to make sure that investors understand where their data is used and make our commitment to the privacy of that information crystal clear. Transparency creates all kinds of new opportunities for advisors and responsibilities today in the age of personalized advice. We've got clients across the investing spectrum, and that means we gather, process, and deliver millions of records from investments, transactions, portfolios, research, and so on. In fact, on a daily basis, our aggregation service for financial advisors, by all accounts, processes more than 1 trillion of assets. Think about that. Every day, 1 trillion of assets flowing through. And none of that data is ending up in the hands of parties that you would consider problematic. Now, you're likely aware that there are some other business models in this space that rely on selling data to hedge funds and other investors who are trying to gain an edge on the investor that we're trying to serve. And this is the 3rd year in a row where I will stand up and say to you that we believe that the advisor and the investor control that data, and they should get to determine if at all it's disseminated broadly. We won't do that, and simply put, you and the investor that we serve jointly are going to continue to be the custodians of that data, and our disclosure will make that clear. By all accounts, we think we have the best aggregation service for advisors. We're so proud of it that even our competitors use it. And part of that is because of the uncompromising privacy that we've built into it. For decades, we've believed that the transparency of fee structures and business practices is in fact paramount to investor success. Today, I believe that the transparency of data privacy practices will be the new and defining criteria that drives investor success. I believe, I'm going to say this again, that transparency of data privacy practices will be the new and defining criteria that drives industry success. So when it comes to using your data or your client's data, we'll always ask for your permission and we'll never put you or ourselves in a position to beg for forgiveness. Now, this means we do forego revenue opportunities, but I believe that we're able to hold more opportunity in an open hand than in a closed fist. This transparency and our belief in democratizing investing extends to how we operate as a public company. It's one of the things I'm most proud of. We went public in 2005 through a Dutch auction, if you're familiar with that, and we're systematically boring and predictable in how we communicate with investors. And I just love that. We take questions on a monthly basis and answer them in a regulatory filing, so all investors get access to that information at exactly the same time, and we provide thoughtful, comprehensive answers. We're not issuing earning estimates, and we're not sitting around talking to analysts. Our firm is at work for you and the investors that we serve. I like to joke, but I think I'm mostly serious, that it's no wonder that companies get the shareholders that they deserve. Meanwhile, as I was saying to one of our shareholders out there, our shareholder meeting is next week in our offices, and while I expect that there will be fewer attendees than those that showed up in Omaha for the Berkshire Hathaway meeting this past weekend, it is the only time of year when I and the management team of Morningstar meet face-to-face with analysts and investors. And so I invite any of you to join us. It's a fun event, and although I can't promise that I'll be sipping any cherry Coke, I think you'll enjoy yourself if you happen to be in Chicago. Now, the last core policy is one that I know we share with a lot of you, and it's a hard one for many people. It's that we invest for the long term. Now, every good investor knows that having a solid plan for today also means that you need to have a solid plan for tomorrow and 20 years from tomorrow. We want to give you solutions that represent our values, and we want to be confident that this isn't going to change. And so we want to develop long-term relationships just like you do. So that allows us to look over the horizon to identify emerging trends and create solutions that capitalize on those trends, even if they haven't shown up in your day-to-day business as yet. Now, a focus on the long term can mean discomfort in the short run, whether you are investing or running a business. You know this with your clients, and we know it with ours. In fact, we just lived through a relatively harrowing example last year. What you're seeing now behind me is our Global Fund Investor Experience Study, where our analysts go through and rate different countries for their level of investor friendliness. Last year, we gave India a below-average ranking for fees and expenses because that market has some of the highest expense ratios for equity and allocation funds in the world. And the industry there relies on ongoing trailing commissions to pay for advice. We know from our experience around the world that this is bad for investors over the long term. And so we said it. And the industry let us know about their displeasure. Asset managers boycotted our conference in India. They canceled sponsorships. And they said that they wouldn't let their managers and executives participate unless we recanted. Our analysts double-checked the data, but stood by it, even as it became a little personal and there were attacks on our local team on social media. But we didn't waver. And the best part is that local advisors valued our conviction. At the end of last year, despite all the threats of boycotts and whatnot, we had a record number of financial advisors show up to that conference. And even more importantly, the Securities and Exchange Board of India took notice of the report and has taken a series of measures that have led very quickly to the reduction in expense ratios for investors in that market. This is the kind of thing that excites all of us at Morningstar, even if it means hurting ourselves from a business perspective in the short run. Of course, for you here today, our commitment to investor success over the long term is likely most evident in our software, which we're showcasing out there in the Innovation Lab. Now, last year, I highlighted the Best Interest Scorecard, which is right behind me. We made it to help advisors see the fiduciary quality of rollover proposals. But some companies weren't happy with the results that the scorecard was delivering. Specifically, not enough products, and annuities in particular, were passing the scorecard's suitability test. Or in some instances, their own products didn't pass the test. But while we built the tool for scale, we didn't build it for sale. The scorecard is driven by solid independent research, and we won't compromise on that. We're not concerned on how quickly a firm can recommend its products. We're concerned with how appropriate those products are for investors and the clients we jointly serve. So in this, we're fully aligned in the important work that you do, and we don't compromise in the solutions we're building. We intend to be here for the long term. You live in a world today where many of the firms you partner with are being bought and sold and changing hands constantly. There's a flood of private and venture capital money entering so-called wealth technology today. And let me tell you, it isn't here to help you or investors. It's there to make money and often make it quickly on a timeline that's very different from your timeline. We're building a firm that we hope will thrive for a long time, and we want to do it in a way where we win only if you do. And in that regard, we are on your timeline versus the other way around. So our opinions are independent, our actions are transparent, and we invest for the long term. This is where we stand, and I invite you to stand with us in this endeavor. Let me now share with you how we're thinking about this today and what you can expect to see this week. First, it starts with the sea of big data that we're all swimming, maybe even drowning in. It's a lot, but we're not overwhelmed because we've always loved data and research. Our data expertise and knack for putting it all in context lets us create research and analytics that can give new perspectives on the markets and portfolios. Those of you who have been coming to the conference know that I like to throw up this chart every year that I speak. What this chart is showing you is an amalgamation of the fair values that our equity analysts assign to the equities that they cover in the US market, transposed against the actual prices of the stocks. You'll see that about late last year, when the markets were starting to fall, our analysts held by their fair values, and in fact, they were right, since the market has rebounded. And we now think it's about fairly valued based on that bottom-up approach. I don't show this to brag, even though I'll tell you that the long-term results of looking at this simple graph are so good. I show it to you because no other firm has the ability to put these analytics together for you in that way. And we do it also because we have access to this huge amount of data. Just look at that. About 250,000 mutual funds, 17,000 ETFs, 44,000 stocks, a huge swath of other asset classes, annuities, indexes, unit investment trusts, more than 5,000 college saving plans, and real-time market data that dwarfs all those numbers. In fact, get this, the size of our tick database is the equivalent of 15 billion Facebook photos. So Facebook would need to store 15 billion photos to match the size of our tick database. Or Netflix would have to stream over 25,000 hours of video to match the size of our database. So we know a thing or two about data. And let me tell you that more is on the way. After hearing from many of you, we're building an HSA database, health savings accounts, and rolling that out later this year. We're also rolling out a new partnership with Mercer, and many of our friends from Mercer are here today to talk about that, to create a single global digital platform for what you know as separate account data. And as we're expanding into providing research on models, we're also adding more data around that. We're broadening our presence in credit ratings, where much work still needs to be done to put investors first. And we're expanding our fixed income and alternative asset capabilities. As these unexplored domains become more relevant to you and your clients, we want to be sure we're mapping them appropriately for you. And the wonderful thing about it is we really believe we know data and we're serious about it. In fact, if you go back and look at how Morningstar invests and spends, For at least the last 5 years, we've spent more than $100 million annually on our data and research efforts. And this year, it's going to reach almost $150 million. So very significant investments in the core part of helping you. We're also investing in the convergence of public and private markets. 2 years ago, I told you that we bought PitchBook, which is the premier provider of private equity and venture cap data. And we welcomed them to our family in 2016 because we believe that the discipline and opportunity of investing in a company is the same, regardless of whether it's private or public. So even as bankers are now starting to hawk IPOs, such as the Pinterest IPO, PitchBook users have already had access to that data and research on the company, dating back to when it got funded. We want to increasingly bring these capabilities to the main stage so that all our clients and the investors that you're serving have access to them. These are particularly important because they successfully bridge the gap between what we think not we think, but what we know investors value and what advisors think investors value. What you're seeing behind me now is a chart that I threw up last year, and we actually went and got updated information. And so this shows a bunch of things that we think are important in the overall planning process. And we asked investors, what is it that you value among these measures? And these were the answers that we got. As a next step, we surveyed advisors, and we asked advisors, what do you think it is that investors value? Take a moment and observe what's going on behind me. You'll see that there are some meaningful gaps between what investors say they value and what you think they value. And this is an important part to work on. We focus particularly on 3 things that I think are of interest here. The first is there's full alignment around helping clients reach their goals. And we think this is important in a world of goal-based advice. Secondly, understanding my needs is one where we think we need to do work to bridge the gap. Because in an era where Morningstar is going to help you focus on personalized advice, we think that needs to be a key part where the advisor and the investor are completely aligned. And the third one, where we believe there's a lot of work to be done, but where we think advisors add a lot of value, is on behavioral coaching. Investors today don't value it. They probably don't even understand it. But all of you do, because you know it's important to that outcome that the investor receives. That's why we're investing so heavily in behavioral nudges and ensuring that our software increasingly has behavioral finance built into it. We've actually built a full-scale behavioral finance research team at Morningstar over the last few years. Now, our upcoming goals-based investment planning tool, which we call Goal Bridge, is designed for this reality. It offers a single workflow for advisors that connects those investor goals to investment plans. You can take a look at it again in the Innovation Lab. And last year, I talked to you about the Model Marketplace, and it is, in fact, ready for you. It lets you browse an open, transparent marketplace of third-party models. You can pick one, customize it, and create a financial plan or investment list for your clients. If you are a user of Morningstar Office Suite, which includes our rebalancing software, TRX, we don't charge any additional fees for using this, and advisors can get access to the models knowing that asset managers are also giving Morningstar no incentive for listing those models on there. Other model marketplaces play this game differently. We want to be transparent and be clear that there are no conflicts in the way we put this together. We're really excited about this. The models are only available through advisors, and you can take it again for a spin in the Innovation Lab. I think you're going to like it. So what does all of this mean? It means we're committed and that Morningstar wants to lead with you. We want to provide an example to the industry that principles are strengths, that they're beacons that can lead us all forward. Just as when you're building a portfolio and trying to move the odds in your client's favor, who you choose to partner with determines whether you're also moving those odds in your client's favor, and especially if you're doing it over the long haul. Last year, I told you that there's never been a better or more important time for great advice, and my conviction on this point hasn't wavered. You might not be surprised when I tell you that about a quarter of US households are on track for retirement success, that only a quarter are on track for retirement success. But I imagine many of you would be surprised if I told you that more than half of US households with more than 100,000 investable assets are also unprepared. Or that even as you're telling your clients that some of them may have to work longer and retire later, in reality, the data is showing that because life happens, clients are retiring 4 years earlier than they planned to. So the need for great financial advice exists at every corner of our financial lives, from savings to major life events to retirement, inheritance planning, you name it. The challenges that face investors, selecting the right strategies, goal planning, managing the emotions of investing, working with the right advisor, these are not selective. These challenges are ever present in our lives, and our research tells us that the single greatest way investors can improve their financial picture is through personalized financial advice. Investors need great advice. Investors need your great advice, and great investing advice makes everyone shine. Thank you again for joining us. We're looking forward to a terrific conference.